The banks crushed the paper price down to the low $60 range. They want you to believe the move is finished. They want you to think silver just completed a speculative blow-off and the party is over. That story is false, not slightly misleading, flat out deceptive. It's a lie of omission so large it borders on intentional blindness. While you were watching the COMEX ticker flash red, while trading algorithms were unloading paper contracts in New York, something far more important happened halfway around the world. Something that makes Friday's price action almost irrelevant. Something that alters the physical reality of the global energy transition. Samsung SDI, one of the largest battery manufacturers on Earth, quietly confirmed the specifications for its next-generation solid-state battery production line. The headlines focused on the obvious talking points: extreme range, ultra-fast charging, safer chemistry. Some outlets called it a breakthrough. Others framed it as a future promise. What nearly everyone missed was the single most critical detail. Not lithium, not cobalt, not nickel. The key material embedded in this battery architecture is silver, and not in trace amounts. We are talking about a structural jump in silver usage per vehicle, large enough to reclassify silver from a secondary industrial input into a core strategic energy metal. A shift so profound it makes existing supply-demand deficits look trivial by comparison. This is not a theory. It is not hype. It is published science and confirmed engineering. In this multi-part analysis, the goal is simple. Expose the silver shock Samsung just injected into the global supply chain. We'll walk through the chemistry behind the silver carbon layer. We'll run the numbers that institutions refuse to model, and we'll show why the recent dip into the low 60s was not a collapse. It was potentially the final window before the auto industry wakes up to a fatal miscalculation. The banks are trading paper. Samsung is operating under the laws of physics. Physics always wins. To understand why this development is so dangerous for silver supply, you need a basic grasp of battery chemistry, no advanced science required. For more than 3 decades, the modern world has depended on lithium-ion batteries, phones, laptops, power tools, electric vehicles. All of them rely on liquid electrolytes to shuttle lithium ions between electrodes. That system works, but it has a fundamental weakness: dendrites. When lithium-ion batteries are charged too quickly or cycled too often, lithium forms microscopic needle-like structures. These dendrites grow internally like jagged roots. Over time, they pierce the separator between the anode and cathode. When that barrier fails, the result is immediate: internal short circuit, thermal runaway, fire. This is why EV charging is throttled. This is why fast charging damages batteries. This is why cold weather destroys range. This is why EV fires make headlines. For years, the industry has chased one solution: the solid-state battery. Remove the liquid, remove the fire risk, enable rapid charging, double the energy density. Every major automaker, from Toyota to Volkswagen, has promised this breakthrough for more than a decade. And they all ran into the same wall. They couldn't stop dendrite formation. Graphite anodes failed. Silicon expanded too much. Pure lithium metal was unstable. Then Samsung SDI's researchers found something different. They discovered that a specific material, applied as a nanoscale composite layer, completely suppressed dendrite growth while maintaining conductivity and stability. Lithium ions could move freely without forming destructive spikes. That material was silver, more precisely, a silver-carbon nanocomposite layer, integrated directly into the anode structure. This is not speculation. Samsung has published the data. Prototype cells already exist. The silver acts as a uniform host for lithium ions, distributing them evenly and preventing localized buildup. The result is a battery that is lighter, safer, faster to charge, and dramatically more energy dense. But there's a catch, a massive one. This design does not use micrograms of silver. It requires grams. For the first time, silver is not merely a conductive accessory. It becomes an active participant in electrochemical energy storage. It becomes embedded in the battery's functional architecture, part of its DNA. And this technology is now being prepared for mass production. That's where the math breaks. You might think, cars already use silver. What's the big deal? Let's put that in context. A traditional internal combustion vehicle contains roughly 15 to 20 grams of silver, window controls, sensors, electronics. An electric vehicle uses more, typically 30 to 50 grams, spread across inverters, power electronics, and battery management systems. That increase alone has already strained supply. It's one of the contributors to the current billion-ounce structural deficit. But solid-state batteries change the equation completely. We are no longer talking about switches or wiring. We are talking about coating the anode material of every cell in a massive battery pack. Early Samsung research suggests silver loading rates in the range of 5 to 10 grams per kilogram of anode material. More aggressive estimates push that number far higher, up to half a kilogram or more per vehicle in large, long-range battery packs. Let's be extremely conservative. Assume solid-state technology adds only 50 grams of silver per car. That brings total silver content in an EV close to 100 grams. Global auto production averages around 90 million vehicles per year. If just 10% adopt this technology, that's 9 million vehicles. 9 million vehicles times 100 grams equals roughly 29 million ounces of new annual demand. Manageable? Only if adoption stays low and assumptions stay unrealistically conservative. If adoption rises toward 50% or silver usage climbs toward 200 grams per vehicle, annual automotive demand alone could exceed 200 million ounces. That is a quarter or more of global mine supply. And Samsung has already moved from theory to pilot production. This is not a 2035 scenario. This is happening now. While paper traders were hammering futures prices, procurement teams were likely securing long-term silver contracts. They understand the math. Without silver, billion-dollar battery factories don't function. This represents a fundamental shift in demand. Historically, silver was an industrial seasoning used in tiny amounts. Price didn't matter. If silver tripled, it barely impacted consumer products. Solid-state batteries destroy that assumption. Silver becomes structural. If a battery pack contains hundreds or even thousands of dollars worth of silver, price suddenly matters, a lot. Automakers operate on razor-thin margins. A few $100s in added cost can erase profitability. They will try to reduce usage. They will attempt engineering shortcuts. But chemistry is unforgiving. Reduce silver too much, and dendrites return. Dendrites return and safety disappears. They are constrained by physics, which makes this demand inelastic. And that's why Friday's price drop wasn't a warning. It was a gift. If you followed Section 1, you now understand what Wall Street is ignoring. The solid-state battery transition is not powered by lithium alone. It is anchored by a silver-carbon anode. Samsung and its peers are preparing to inject enormous quantities of silver into the automotive supply chain, not as decoration, but as a functional necessity. Now we have to confront the uncomfortable question, is there actually enough silver on Earth to support this shift? This is where the story stops being bullish speculation and turns into hard arithmetic. This is the math the IEA avoids publishing, the math that governments don't want to acknowledge, the math that makes a $60 silver price impossible to defend. Let's start with the world as it exists today, before solid-state batteries fully arrive. Global silver mine production sits near 830 million ounces per year. Recycling contributes roughly 180 million ounces. Combined, it gives us just over 1 billion ounces of annual supply. Now look at demand before the Samsung shock. Industrial use, electronics, solar, medical, infrastructure consumes around 600 million ounces. Jewelry and silverware absorb roughly 200 million ounces. Investment demand, in the form of coins, bars, and ETFs, averages another 200 to 250 million ounces. Add it up and you already have a deficit. Even in a normal year, the world consumes more silver than it produces. The difference comes from above-ground inventories, vaults, stockpiles, and legacy reserves. Those reserves are being drawn down year after year. The buffer is shrinking. Now introduce solid-state batteries. Let's run a moderate adoption scenario. By the late 2020s, suppose 40% of new vehicles are electric. That's realistic given current policy mandates. If just 20% of those EVs adopt solid-state batteries, you're looking at roughly 7 million vehicles per year. Assume a conservative silver loading of 50 grams per vehicle. That equals about 11 to 12 million ounces of new annual demand. Painful, but survivable. Now remove the conservative assumptions. What happens when adoption accelerates to 50% of EVs? What happens when battery packs for trucks, SUVs, and performance vehicles require 200 grams or more of silver? Run the numbers again. 18 million vehicles multiplied by 200 grams equals roughly 115 million ounces of new demand every year. That is more silver than an entire top-tier producing nation mines annually. And this is just one industry. Solar demand continues to rise. Electronics demand does not disappear. Medical and defense usage does not decline. Investment demand doesn't politely step aside. This is the extinction equation. At a certain point, industrial demand alone approaches or exceeds total mine supply. When that happens, silver stops being a freely traded monetary metal. It becomes a controlled industrial input. You won't compete with price. You'll compete with allocation. This is where skeptics usually interject with a comforting myth. Recycling will solve it. It won't. Gold is recycled at rates approaching 90%. Silver is not. The reason is dispersion. Silver is used in microscopic quantities across billions of products. Phones, laptops, appliances, circuit boards, solar panels, military hardware. Recovering that silver is often more expensive than mining fresh ore, so it goes to landfills, buried, lost. We are not recycling silver, we are entombing it. And even where recycling is feasible, timing matters. A solid-state battery installed in a vehicle today won't be recycled for 10 to 20 years. The silver inside it is removed from circulation for an entire generation. So the recycling wave everyone is counting on arrives too late to solve the shortage of the 2020s. The deficit is structural, the consumption is destructive, the sequestration is long-term. That leaves one supposed solution: more mining. But this is where geology steps in. You cannot print a silver mine. From discovery to production, a new mine takes 10 to 15 years, assuming permitting, financing, and politics cooperate. Even if a massive deposit were discovered tomorrow, it would not deliver ounces until the mid-2030s. Meanwhile, existing mines are deteriorating. Ore grades have collapsed. 2 decades ago, a strong silver mine produced over 15 ounces per ton. Today, 4 ounces per ton is considered good. That means more rock, more energy, more water, more cost, just to maintain flat output. And then there's geopolitics. Mexico supplies roughly a quarter of the world's silver. New mining permits there have slowed dramatically. Peru faces labor unrest and political instability. Russian supply is constrained by sanctions. Environmental opposition is rising everywhere. So precisely when demand is poised to surge, supply growth is stalling or reversing. This is a pincer movement, exploding demand on one side, constrained supply on the other, and no inventory buffer left in the middle. The only variable that can adjust is price. This creates a paradox governments are unprepared for. They have mandated the transition to electric vehicles. They're subsidizing battery factories. They're setting deadlines for the internal combustion engine. But they fail to check the periodic table. If silver prices rise sharply, as the math suggests they must, the cost of solid-state batteries rises with them. EVs become less affordable. Adoption slows. Political goals are threatened. So what happens next? History gives us a clue. When a material becomes critical to national policy, markets stop being free. Governments intervene. Silver gets reclassified as a strategic resource. Industrial users receive priority. Retail access becomes secondary. In extreme cases, sales restrictions appear. Minted coins disappear. Supply is redirected. If a major automaker tells a government, "We can't meet your EV mandate because we can't secure silver," the response will not be, "Okay, never mind." It will be, "We'll get you the silver." National security always outranks market ideology. Samsung is not just a corporation. It is the backbone of an economy. South Korea will ensure supply. The US will do the same for domestic manufacturers. Europe will follow. Silver is quietly crossing the line from commodity to strategic asset. And that's why Friday's $61 price doesn't reflect reality. It reflects delay. By this point, you have information that most of Wall Street is still ignoring. You understand that the solid-state battery transition depends on a silver-carbon anode. You understand that this single technological shift has the potential to consume well over 100 million ounces of silver per year. And you understand that geology and mining timelines make it impossible for supply to respond fast enough. So here we are. The price has been smashed down into the low 60s. Fear is everywhere. Retail traders are shaken. Headlines are confusing. But the fundamentals have not weakened. They have hardened. The only remaining question is positioning. Knowledge alone does nothing if you don't act correctly. So how do you prepare for a world where industrial buyers, not speculators, set the floor for silver? Do you buy coins? Do you buy mining stocks? Do you buy paper exposure? The answer is not simple, but the rules change dramatically during an industrial squeeze. There are 3 primary lanes in the silver trade, and each behaves differently when supply becomes critical. The first lane is physical metal. Physical silver is insurance. It is wealth outside the system. But even here, strategy matters. For years, dealers have pushed collectible coins and semi-numismatic products. Limited runs, special designs, high premiums justified by scarcity and aesthetics. In a normal market, those premiums can hold. But this is not a normal market. When Samsung or an auto supplier needs silver, they do not care about artwork, grading, or collectability. They care about atoms, weight, purity, melt value. In a true industrial shortage, the buyer of last resort is not a collector. It is a refiner. That means premiums on fancy silver collapse relative to spot. The floor becomes the raw metal value. If silver trades at $100, the industrial buyer pays $100. They are not paying $150 because a coin is pretty. So the strategy changes. Stop paying for art, start paying for weight. Low premium bullion becomes king. Government issued coins with tight spreads, 10-ounce bars, 100-ounce bars, recognizable liquid forms that move easily through the supply chain. Density matters, storage matters, maximum ounces per dollar becomes the priority. In an industrial squeeze, silver stops being a collectible and becomes inventory. The second lane is mining equities, and this is where fortunes are made or missed entirely. Not all miners benefit equally from rising prices. The biggest trap is hedging. Many mining companies lock in future sales at fixed prices to reduce risk. When silver was cheap, this made sense. But in a rising market, hedging is poison. A miner that sold forward production at $30 is still selling at $30, even if silver trades at $90. The bank captures the upside. Shareholders get crumbs. You want unhedged exposure. An unhedged primary silver miner sells every ounce at the spot price. That creates leverage. When silver doubles, revenue more than doubles. Profit margins explode. Stock prices can move 10 or 20 times faster than the metal itself. Costs matter too. A miner with all-in sustaining costs of $20 generates $10 profit at $30 silver. At $100 silver, that becomes $80 profit. The metal rises threefold. Profit rises eightfold. That is operating leverage. But even within miners, selectivity is critical. Most silver comes as a byproduct of lead, zinc, or copper mining. Those companies don't care about silver. It's incidental. Rising silver prices barely move their valuation. You want primary silver producers, companies whose survival depends on silver prices. Those are the assets industrial buyers may eventually target directly. Equity stakes, offtake agreements, strategic partnerships. When battery manufacturers realize they cannot secure supply on the open market, they won't wait for spot prices to save them. They will buy the source. The third lane is geography, and this may be the most overlooked factor of all. Battery supply chains are now political. Governments have tied EV subsidies and tax credits to sourcing from friendly jurisdictions. Silver mined in sanctioned or unstable regions may become unusable for qualifying vehicles. This creates a two-tier silver market. Silver from stable jurisdictions, Canada, the United States, Australia, commands a premium. Silver from politically risky regions carries hidden supply risk. Expropriation, strikes, permit cancellations, export controls. As prices rise, the temptation for governments to seize resources increases. History is clear on this. High prices invite intervention. A mine in Nevada is not the same as a mine in Bolivia, even if the ore grade is identical. One is strategic, the other is vulnerable. If you own mining stocks, look at the map. Jurisdiction matters as much as grade. Now, let's talk about exit strategy, because no trade lasts forever. The silver carbon anode is the dominant solution today. It will drive demand for years. But technology evolves. In a decade, a new chemistry could emerge. Sodium batteries, alternative composites, something that reduces or replaces silver usage. Commodity cycles driven by technology typically run 7 to 10 years. Uranium in the 2000s, cobalt in the 2010s. We are at the beginning of the silver battery cycle. That gives you time, but not eternity. The strategy is not to marry the trade. It is to ride the macro trend, then rotate. Accumulate during disbelief. Hold through recognition. Exit during euphoria. If headlines someday announce a commercially viable, silver-free, solid-state battery, that will be the signal. Until then, factories built today are locked into silver for multiple production cycles. They cannot pivot overnight. For the foreseeable future, Samsung's demand sets a floor under silver, which brings us back to the present moment. It's the weekend. Markets are closed. The price is frozen near $61. The fear is loud, but nothing fundamental has changed. The chemistry did not reverse, the mines did not multiply, the battery factories did not vanish. This drop was psychological warfare. And the next phase begins when markets reopen. In the next section, we will look at the immediate mechanics of the coming week, how physical markets in Asia interact with Western paper markets, why price suppression has limits, and what signals actually matter when the noise ramps up. Now we move from strategy to timing, because this is where most people lose their nerve. The fundamentals can be perfect, the math can be airtight, and still people sell at the worst possible moment. Not because they're wrong, but because the system is designed to exhaust them psychologically. We are standing in that moment right now. It's the weekend. The price is frozen. Friday's sell-off is still fresh in everyone's mind. The narrative being pushed is simple. Silver failed, the breakout was fake, the rally is over. That story is being repeated for one reason only: to get metal out of weak hands before the next leg higher. While Western markets sleep, information travels. The news about Samsung's battery specifications doesn't stop at the New York close. Engineers, procurement teams, commodity desks, and sovereign funds are processing it in real time. And when markets reopen, price must reconcile with reality. The key mechanism to watch is not the COMEX chart, it's the physical premium in Asia. The Shanghai Gold Exchange operates differently from Western paper markets. It is primarily a physical delivery exchange. When buyers step in, metal moves. And right now, there is a growing disconnect between paper prices in New York and physical prices in Asia. On Friday, futures were driven down into the low 60s. But in China, physical silver is trading several dollars higher once premiums are included. That gap matters. Anytime silver is cheaper in New York than in Shanghai, an arbitrage opportunity appears. Traders can buy paper contracts in the West and sell physical in the East for a near risk-free spread. But to do that, they must buy. And buying pressure collapses artificial price suppression. This is the invisible force that limits manipulation. It doesn't happen instantly, but it happens relentlessly. When Asian markets open, algorithms scan for these discrepancies. If the gap is large enough, capital floods in, paper is absorbed, price lifts, not because of sentiment, but because math demands it. That's why weekend smashes are often erased quickly. They rely on low liquidity and fear. But physical demand does not negotiate with fear. If the gap persists, expect the price to snap higher, possibly in a single session. A jump back into the mid-60s would immediately invalidate Friday's narrative and trap short positions open during the smash. That's when volatility accelerates. And volatility is the bank's last weapon. When fundamentals can't be disproven, they attack psychology. Sharp rallies followed by violent drops. Conflicting headlines, sudden margin hikes. Anything that induces motion sickness and emotional fatigue. They don't need you to be wrong. They just need you to quit. This is why watching the price every few minutes is dangerous. It pulls you into their arena. Instead, you watch the signals that cannot be faked. Premiums, inventory, delivery delays, out-of-stock notices. If spot drops but physical premiums rise, the move is artificial. If spot drops but dealers have no inventory, the move is artificial. If spot drops but industrial buyers continue to secure supply, the move is artificial. Paper is loud. Physical is honest. This disconnect will grow as silver becomes more strategic. The more silver is needed for batteries, the less available it is for speculation. And the less available it is, the harder it becomes to suppress. At some point, the market flips. Instead of asking, is silver expensive? Buyers start asking, can we even get it? That is the moment when price stops behaving normally. It gaps, it overshoots, it ignores valuation models built for a world that no longer exists. And that moment usually arrives faster than expected. The most important thing to understand right now is that nothing about Friday's move changed the core story. The chemistry didn't change. The adoption timeline didn't slow. The mines didn't magically expand. The deficit didn't disappear. What changed was sentiment, and sentiment is the easiest thing to manipulate in the short term. This is where discipline matters. If your thesis depends on a daily candle, you don't have a thesis. You have a trade. But if your thesis depends on physics, geology, and industrial necessity, daily volatility becomes background noise. Silver is being pulled into two massive trends at the same time: energy transition and electrification. Both require more silver, not less. Both are accelerating, and neither cares about paper positioning. As this pressure builds, governments will begin to notice. When silver shortages threaten industrial output, policy responses follow. Strategic stockpiles, export restrictions, prioritized allocation. The free market quietly steps aside. That's why this phase feels uncomfortable. The transition from financial asset to strategic resource is never smooth. It's marked by denial, suppression, and sudden repricing. You are in the denial phase, which brings us to the final piece: perspective. People always underestimate how quickly markets can reprice once a narrative breaks. Palladium didn't rise gradually. Uranium didn't politely trend higher. They exploded once the shortage was undeniable. Silver is setting up the same way, but with broader implications. Because this time, the demand is not speculative. It's structural. And structural demand does not leave quietly. In the final section, we'll bring everything together: the technology, the math, the psychology, and the timing. We'll talk about what to expect next, how the narrative shifts, and why this moment, right now, will look obvious in hindsight. We've reached the final moment of this analysis. If you've stayed through every section, you now see the entire picture clearly. You understand the technology, you understand the supply math, you understand the positioning, and now you understand where we are in time. It's the weekend. Markets are closed. The price is frozen. Silence fills the gap between sessions, but that silence is misleading. Beneath it, the system is adjusting. The events that matter most never announce themselves with flashing headlines. They unfold quietly inside procurement offices, engineering labs, and government agencies. While retail traders argue over charts, decisions are being made that lock in silver demand years into the future. Samsung has already crossed the line from research to execution. Battery factories are not built on speculation. They are built on supply assumptions. And once those factories are online, the silver demand is non-negotiable. It does not pause because of volatility. It does not retreat because of sentiment. This is what the market has not priced in. The paper price you see on a screen is a financial abstraction. The silver required to manufacture batteries, solar panels, and critical electronics is a physical reality. Eventually, the abstraction must reconcile with the physical world. When that happens, repricing is not gentle. As markets reopen, attention will turn to arbitrage, to premiums, to delivery timelines. Physical buyers in Asia will continue to signal stress long before Western analysts acknowledge it. That stress will travel back through the system, forcing paper markets to adjust whether they want to or not. The pattern is always the same. First comes denial, then suppression, then volatility, then shortage recognition, then repricing. We are transitioning out of denial. Over the coming days and weeks, you will see contradictory headlines. One day silver will be declared dead. The next day it will surge. This is not confusion. It's control. Volatility is used to exhaust conviction. The goal is not to prove you wrong. It's to make holding uncomfortable enough that you leave early. That is the psychological battlefield. But the facts do not change. Silver is being absorbed into the foundation of modern energy systems. It is no longer optional. It is no longer peripheral. It is becoming essential. When materials become essential, price discovery changes. Scarcity is no longer theoretical. It becomes operational. Buyers stop asking what something costs and start asking whether it's available at all. That shift does not happen gradually. It happens suddenly, after years of complacency. When it does, the public response is always the same. Surprise. People will say no one could have seen it coming, that it happened overnight, that the move was unpredictable. It wasn't. The signals were there. The chemistry was published. The deficits were documented. The mines were struggling. The batteries were being built. The only thing missing was attention. Attention always arrives late. That's why moments like this matter. Not because they feel good, but because they feel uncertain. Because they test patience. Because they force you to decide whether you trust the daily noise or the long-term reality. Friday's price action was not a verdict. It was a tactic. The banks are playing a paper game. They always have. Paper can be printed, sold, rehypothecated, and leveraged. It creates the illusion of supply. Physics does not operate on illusion. Electrons do not respond to narratives. Lithium does not care about sentiment. Silver does not multiply because a chart says it should. Factories require inputs. Batteries require materials. And materials must come from somewhere. That is the immovable foundation beneath all of this. In the years ahead, silver will not behave like it has in the past. It will not trade purely as a monetary metal or a speculative commodity. It will trade as a strategic input to energy, transportation, and national infrastructure. Those markets do not tolerate prolonged shortages. They respond forcefully. What you are witnessing now is the early stage of that response, the quiet stage, before the headlines, before the panic, before the rush. When this period is looked back on, the question will not be whether silver was volatile in the short term. The question will be why so many ignored the obvious long-term setup. You now understand it. The rest is patience. The system will do what it always does. Delay, deny, then reprice violently. You don't need to predict the exact day. You just need to recognize the direction of inevitability. Silver has crossed a threshold. It is no longer just money. It is no longer just metal. It is infrastructure, and infrastructure always wins in the end.